Welcome to the Money Maze podcast. If this is your first time joining us, I'm the host, Simon Brewer. From sovereign wealth funds, private equity to Hollywood actors, the world of sports has been undergoing an investing revolution. Traditionally the preserve of club owners and a few exceptionally wealthy families, some in search of trophy assets, the last few years has seen a quantum increase of new investors investing both in sports and even the governing bodies, raising investment questions about potential hype, durability and returns themselves. One of the principal actors in this development has been the US firm Arctos, run by co-founder Ian Charles, and counting amongst their investments are sports franchises, including baseball's Boston Red Sox, Liverpool Football Club, Paris Saint-Germain, and more recently Aston Martin F1 Racing. And I hope today we'll learn more about the size of the market, the investment logic, competition, regulation, building the brand, using data, as well as exits and returns. So, Ian Charles, the co-founder, partner of Arctos, so welcome to the Money Maze podcast.
I appreciate the opportunity to be here. It's a huge honor, and I'm excited to jump into it. Thank you, Sam.
Now, are you going to shatter my illusion and tell me that it's all about the numbers and you've never been really passionate about sport?
I grew up in a part of the United States where professional sports is not an integral part of the fabric of that community. And so sport for me is about teamwork. It's about learning how to be a good loser, winning with dignity, coachability. Sport teaches you so many valuable lessons. So I love sport. I just didn't grow up in a family where consuming professional sport was part of our rituals and routines. And so my colleagues love to make fun of me because before starting Arctos, I didn't really know a lot about sports. I would butcher European Football League names. I wouldn't know the right mascot for the right club. I am an entrepreneur who has spent my career in private markets. So my background and my expertise is all about unlocking illiquidity, serving the institutional investor community, and building different kinds of businesses around private markets. And I've been working my ass off trying to learn sports for the last 5 years, but I'm lucky to be partnered with a bunch of really knowledgeable, really experienced people who come to Arctos with tremendous experience in sports and live entertainment.
Well, your investors or would-be investors would be excellent because they'll probably think that puts you in the dispassionate camp and therefore great objectivity.
I'm definitely a math guy.
So we're going to come to that because I read that you studied at Texas Christian University, then you did your MBA at Wharton, and funnily enough, we just had Cliff Asness on and we're releasing his episode, who is another alumni there, and a really interesting interview with some departures into the private equity world and volatility, etc. But we won't talk about that right now. But you just hinted at it, but just tell me how your journey into private equity began. So
I was pretty convinced when I got to university, I was going to be a physics professor or a high school physics teacher. And so I started in kind of the engineering and hard sciences route, but the math got pretty tough. And one of my roommates was a finance major, and every week he'd get a new variable in his macro GDP equation, and is literally just a linear math equation. And I would kind of tease him about how easy that math was. And then he would tease me that he was going to make more money than me. And I started to get interested in finance. But I had started a software business in undergrad while I was at Texas Christian University, and was so frustrated because I had not been able to raise venture capital money. And in that time frame, it felt like a dog with a business plan, especially if the dog had gone to Stanford, could raise money. And I got frustrated by that. So I asked one of my professors to sponsor me in an independent study of venture capital and private equity because I wanted to understand why I had failed at attracting this capital. And that gave me the license to spend a few months my senior year at TCU interviewing associates and senior associates at some of the early private equity firms in Texas. And I just fell in love with this industry because it was this merger of entrepreneurship, which I knew I was passionate about, and finance, which I was learning a lot about. And the two things came together to finance innovation and entrepreneurship in venture capital and private equity. And so I knew that was where I wanted to go. I knew that's what I wanted to do. And I was lucky enough to get a job right out of Texas Christian University at a platform that invested in private equity funds and co-invested in private equity funds. And that firm is now the Neuberger Berman private equity platform. It's really grown and evolved over the last 20, 25 years.
So I have to ask you before we get there, which is, what was the lesson of why you had failed to raise money?
Well, it's so obvious now. I was a punk kid who was still in college, who had convinced two really great executives to leave their jobs and run this business while I was at school. Neither of them had been entrepreneurs. It was not in a sexy industry. All of those, like any one of them should have been the kill shot, but we had all of them. So of course we couldn't raise any money. But that team bootstrapped that business, did an incredible job. And that business is still serving its customer base in really innovative ways. And the two people that agreed to leave their jobs and start that business, they still run that business. It's awesome. And I check in with them, once a year, once every 2-3 years. It's a cool American entrepreneurship story, but there's millions of those, right? You don't need venture capital money to build a successful business, but it certainly helps you build something of scale faster. Right? So those were lessons I took from it.
Yeah, and in fact, I mentioned just in our pre-chat that we had Mike Horvath from Strava, the co-founder of Strava, and he talked about some of those decisions around being careful about choosing your investors and listening. He said, don't listen to your investors, listen to your clients, because your investors often tell you the wrong thing. We might get to that because you spent time at Cogent and Landmark pre-Arctos. How did each of those experiences equip you for the journey ahead?
They were both incredible experiences, right? So I was the youngest of the co-founders of Cogent. So while we were at this fund of funds platform, one of the things that firm did is buy secondaries. And it was such an episodic, unusual opportunity. When it came in, people got excited and they loved to talk about the secondaries they had done, in the years prior. And it just seemed strange to a couple of us that an investor in a perfectly good asset had to take such a massive discount. It just seemed strange. And so we put this business plan together that everybody told us was a bad idea. Market's not big enough. There's no repeat clients. Nobody really needs this service. There's only 5 or 6 buyers. Well, why do you need this advisor? But no one gave us a data-driven, cogent, no pun intended, argument why it wouldn't work. And we were all young. We had a little bit of courage. We had a lot of stupidity, and we went for it. And we couldn't have gotten luckier because the tech wreck had started to manifest itself in private equity fund performance. And for the very first time, institutional investors were deciding, wait a minute, private equity might not be different than equity. It's not working, or this manager didn't do what they said they would do. And that was the very first wave of secondary selling from institutions that were still committed to the asset class. And if you wanted to sell, and you wanted to sell in an intelligent way, we were literally the only firm in the world you could hire. And so it was a rocket ship. And that firm, Cogent, and our co-founding team, we changed the cost of illiquidity forever in the asset class. And I think one of the things that the secondary market doesn't get enough credit for is the perception of liquidity. Because the secondary market's not as deep as people think it is in private equity. But the perception of that liquidity has allowed many institutions over the last 20 years to start their allocation to private markets or grow their allocation to private markets. I learned a ton there. I learned a lot about building teams, culture, illiquidity premia, decision-making process for institutional investors. I had the opportunity to build a data science business for Cogent, which improved our competitive positioning. But ultimately, I left to join one of the original buyers in the secondaries market, Landmark Partners, which is now part of Ares. Incredible brand, incredible team, really unique position. And the opportunity they gave me was to help them build competitive advantages around origination and data. And so I was there for 15 years. When I decided to leave and be a part of founding Arctos, I didn't bring any sports domain expertise. What I brought with me was a subset of our co-founding team that had backgrounds like mine, that knew a lot about illiquidity, knew a lot about secondary market formation, entrepreneurship, and firm building in private markets. And we married that skill set that half of our founders brought to the table with deep operating experience, running clubs, working for leagues, building, being entrepreneurial in sports and live entertainment. We married those backgrounds together in a first of its kind firm to take advantage of the brand new opportunity that was investing in North American sports franchises.
Got it. So let's talk about Arctos today. I believe you are both in Dallas and New York. You're one of the leading, if not the leading, private equity firms specialized in taking stakes in professional sports franchises and providing liquidity. And I think you might now manage, a vast amount. I think I read 7 billion. Tell us if that's right, but more importantly, how would you describe Arctos to somebody who doesn't know them?
We describe Arctos by talking about our passion and our niche. Our passion is innovating and disrupting the markets that we serve. And our niche, how we do that, is by solving complex problems with creative solutions. Okay? It's our passion and our niche. Didn't say anything about sports there. That is the language that describes how we think about alpha generation. The two markets that we apply that alpha engine to are professional sports, which is a very large, underserved, undercapitalized market, and we do that through our sports fund franchise. And we apply it in private markets, helping the leaders of great private markets firms unlock the most important opportunity or constraint for their franchise. We do that through our Arctos Keystone fund strategy. Today, we have regulatory assets under management of about $10 billion, which for a firm that's about 4.5 years old isn't too bad. Both of those strategies are served by a data science and analytics and research platform that we call Arctos Insights. And that business serves the leaders in private markets and the leaders in professional sports. It drives unusual engagement and identification of opportunities to collaborate that allows our team to be a thought partner to the leaders of these businesses. And each of the leagues in North America is heavily regulated by the league. And over the last 4.5 to 5 years, each of those leagues on their own timeline and their own process have created a framework where funds and institutional investors can apply to be an owner and then go try to find someone who wants to be their partner. We are the only firm in the world that has that approval in more than one league. We are the first firm to get that approval and own equity in each league. And our mission is to be the partner of choice for the best owners in professional sports. And we do that in a lot of really innovative ways that I'm sure we'll get into.
Before we talk about that total addressable market, I have read, so I'm not going to be rude, that you described yourself as a bit of a nerd, and that was all to do with the data. And you've obviously found something in the data that really got you going. So just help those of us who don't maybe spend time in the data like you did. What did you discover?
My data-driven interest in this sector actually started circa 2013-14. I'm sitting inside of this data business that I helped build Landmark. Part of what we did was, if you were a large limited partner or a large general partner, you could plug your data in and we would tell you really interesting things about your portfolio or your program, what you were good at, what you weren't. And a couple of times in that 2013-2014 window, big families put their private markets portfolio into our machine and they owned a piece of a pro sports team. And I had a rule: if we saw the same weird thing 3 different times in 6 months, I would staff it with a research team. Because either the typical owner of that thing thinks that thing is about to do a dirt nap and they're trying to lay it off on you, or the natural holder of that thing is systemically going through some kind of liquidity squeeze and there might be opportunity. So that rule got triggered, staffed that team, and we studied professional sports. And the more we studied it, the weirder things started to get. Because I'm going to describe some clean data characteristics of sports. But all of this language that I'm about to use is specific to the North American sports leagues. Okay? The business of North American sport is not pro-cyclical and it's not counter-cyclical. It's anti-cyclical. It is not correlated with GDP growth. And it's one of only 3 sectors in the United States that has consistently compounded rolling 3-year revenue growth at greater than 6% for decades. The other 2 are education and healthcare. It has expanding margins over the last 20 years. The equity returns and the enterprise value returns, so ROE and ROI, have been comparable to alternative assets, public equity, and private equity when those things did well, and vastly superior to those things when they didn't do well. There's almost no correlation whatsoever in the return streams of North American sports with fixed income, with equities, with venture capital, with private equity, and there's no leverage. The North American leagues don't let you lever these assets in any material way. And so you have this really strange compounding asset that has turned into a negative cost of carry asset that has this very strange disruption and obsolescence risk of almost 0, that has outperformed equities in all kinds of environments, and has performed in line with alternatives during the peak performance phases of alternatives with no leverage. And there's a lot of math behind all of those things, but those were the characteristics that we identified, and we saw a very large secondary-like opportunity because there are thousands of minority owners, limited partners in these companies that from time to time need or want liquidity. Just like 20, 25 years ago when we wrote the business plan for Cogent, there were thousands of limited partners who from time to time needed or wanted liquidity. They just didn't have a mechanism to get it. So from my perspective, it was a secondary-like opportunity with a very large discount to intrinsic value available in a market that has very hard to replicate beta factors. Problem was the leagues wouldn't let you do it. And if a regulator says you can't, you can't. But that started to change in April of 2019 when Major League Baseball took the very innovative step of creating a new kind of owner called a covered fund. And Arctos was the first covered fund approved by Major League Baseball. So the sports ecosystem is massive, and institutional investors have exposure to the sports ecosystem, and they have for decades, right? Sports gambling, sports data, player agency businesses, venue operations. Like, there are all these ancillary businesses in the ecosystem that have been part of private equity programs for decades, typically in like a growth category, maybe a buyout category. But all of them feed on the harvest that is the franchises and leagues and the content that comes out of that. That has been inaccessible in large part to institutional investors, except for the last 5 years, okay? Where we're focused as a firm is in that heart of the intellectual property and content and brands that are the leagues and the clubs. And if you look at the 5 North American leagues, which have those unique risk-return characteristics that I described, Major League Soccer, Major League Baseball, the National Hockey League, the NBA, and the National Football League. There are also about 30 to 40 global properties that, for very idiosyncratic reasons, have achieved a scale and global audience where their balance sheet, income statement, and revenue streams behave like the North American sports. If you take all of those properties in the aggregate, there's about 175 of them. The value of those assets and everything that their holding company that they sit in owns, arenas, venues, mixed-use real estate around it, sports, all of the value held in that 175 properties is approximately $500 billion. And we have built a proprietary database of the ownership of those 175 platforms, and have identified over 2,000 limited partners or minority owners in those businesses. So on average, you've got about 13 non-family member owners in these assets. And that is the secondary opportunity we identified, is that from time to time, those minority owners need or want liquidity. People die, they get divorced, they get pissed off at their buddy, they want to buy into a different team, estate planning, whatever. It looked almost exactly in scale and quantum to the buyout market in the US and Europe in 2007. In 2007, all of the leveraged buyout net asset value held by institutional investors was approximately $500 billion, and it was held by a couple thousand LPs. And so, again, from my perspective, I'm framing this up so you can see what I saw. I saw a massive secondary opportunity with regulatory constraints that would make it hard for capital to flow in. And I knew we had a team that had tremendous experience unlocking illiquidity in markets like this. And it was connected to very well-respected operators who had deep networks. And those two things combined gave us a real shot to transform that part of the sports market. And if we were lucky, we might also be able to provide growth capital to these businesses, because these businesses are going through a huge inflection point of growth opportunity that requires capital. And remember, you're not allowed to use leverage. And so there's a constraint there where you can only grow as fast as you can generate free cash flow and plow it back into the business, unless you can take growth capital. And so our hope was other leagues would follow on their own timeline and their own way and open up to institutional capital, and that we could be the premier provider of liquidity when people needed it or wanted it, and growth capital to the owners that wanted to grow and had a big vision. That was our thesis.
And I think you've described the playing field extremely well. I just want to hone back in on this and it came from one of your documents I read, is that up to now, or recently, the actual growth has been lower than the potential growth. And I'd just like to understand, just help us understand, what are the strands or the threads that are important to create that sustainable higher growth level?
So let's frame up some of the growth nodes that are available to these businesses. And then let's talk about the financing required to unlock them. And what I'm about to describe is only true in the North American leagues. And that's part of what makes their economic data so unique. Every North American team in those big five leagues is at least two things. And for a US investor in a US asset, it's three things. Okay? Every North American team owns a fractional, equal proportion in its league. And the league is its own operating business. The league sells international and domestic media rights. It sells data rights. It sells sponsorship. It has commercial agreements everywhere to do lots of things, and it generates tremendous revenue. And almost all of that revenue is in very long-term contracts with escalators. It is very infrastructure-like, if you think about it. The league has its cost of operation, and it generates tremendous free cash flow. Some of the leagues also have like balance sheets where they make strategic investments. So most of the leagues have a balance sheet component and then a massive cash flow royalty stream. And each of the leagues owns 1/30th or 1/32nd of that very valuable IP business. Okay, that has almost no counterparty risk. Right? Your biggest counterparties are Amazon, Disney, Netflix, like your media partners, but you typically have many of them. Okay? It is an investment grade cash flow stream. And some of the leagues actually have investment grade credit ratings. Okay? So you can think of it like an investment grade coupon that actually has growth. Then the club is a local live entertainment business that has a protected geographic region where no one can compete with you. You have a co-op where the team that's closest to you, there's a line, and neither one of you can cross it to sell sponsorship and tickets and media rights. And so in many ways, you have a monopolistic or a duopolistic pricing power in your market for live entertainment spend. And you might use that advantage to own the arena and monetize all the content that comes from the arena. You might be an owner in the mixed-use real estate around the arena, where you can activate the fan and deliver energy and traffic in a way that most real estate plays can't today. There are real advantages and synergies to owning multiple franchises. So if you can use one franchise to be the platform to buy another one, that's called platform building in sports. The platforms have advantages in talent, in revenue, and in margin. Increasingly, the leagues are also letting the clubs build their brands internationally. The leagues are also trying to figure out what kind of businesses and revenue streams can they build for future growth at the league level. This is just some of the opportunity. It's the stuff that's visible right now. Helping the leagues build league level businesses, it's a lot of capital. The real estate is capital intensive. Investing in your venue and optimizing the revenue generation of your venue through more premium offerings, different food offerings, more retail. All of these growth nodes require capital. The leagues do not let the clubs use a lot of leverage. The average Maximum LTV in North American leagues is 15%. That's the max. Most of them run debt-free. And so if you want to take advantage of these growth opportunities, or you want to become acquisitive and buy other franchises, it's very capital intensive. Leverage is not available in large quantums. And so you are constrained. If you want to unlock that opportunity, you are constrained by your internal free cash flow generation or new equity financing. And before institutional capital was allowed, bringing in new money meant you had to find another person. When people are cutting 9-figure checks, they want to tell you which players to pick, which coach to hire. Institutional investors are not allowed to be involved at all in the execution of the on-field strategy. You can just be helpful building the enterprise. And so for an owner who wants to grow, who either can't or won't use leverage, the idea that they don't have to find other people to help finance their vision, they can actually bring in a partner with scale capital, operating experience, value-added capabilities to help them unlock that vision faster or help them make that vision bigger. That wasn't available like it is in every other industry until 5 years ago.
So, we're going to talk about international in a minute, where some of these characteristics aren't apparent. But one of the things that struck me is in most of these cases, you're taking minority stakes. And in many businesses, a minority stake it leaves the buyer of that minority stake with limited room for maneuver. So just help me understand, as a minority owner, how you get a disproportionate voice at the table.
So there are many private market strategies that are non-control. Venture capital is non-control. Growth capital, non-control. Secondaries, non-control. GP stakes, non-control. Our team's investing track record, all of our historical alpha generation has been in passive strategies. We're very comfortable not having control. We were trained to be non-control investors. We were trained to identify, price, and structure risk. And so when I talk about our founding team's formation with intent, it was purpose-built specifically for this strategy because the leagues in North America do not relent and they do not allow active governance in the decision-making of player, personnel, and on pitch, on ice, on court performance. They just don't. And so one of the things that makes it hard for other firms to compete with us, if you are a control buyout firm, you're not allowed to have control, you're not allowed to use leverage, you are off mandate and you are not in your wheelhouse or your right to win. And there's many other constraints that make it hard for other private equity platforms to compete with us from a regulatory perspective. Mandate fit is one of them.
So if I had heard, as an investor, the story that you've outlined, I would think I really like the barriers to entry. I like the dynamics of that business. I think I might never want to leave the North America. And yet, of course, you, along with others, have. And so we should talk about a couple of examples and why it is that with different operating dynamics, you've been encouraged to invest there. And I've noted that maybe last autumn, you invested in the Aston Martin Aramco Formula One team. Help us understand a little bit your thinking and how you went about that.
Awesome questions. I want to tick through a couple things. You said you started that question with a statement that the North American pitch seems obvious, right? When we started this place, when we were sharing our vision, 80% of the people we met thought we were crazy. Didn't see it. It was not obvious. Only one league had changed its rules. It wasn't clear what the rules might look like in the other leagues, if they were even going to change them. Our team, we had these two really awesome backgrounds, but we had never worked together. There were so many reasons why LPs said, I'm going to watch you guys, right? But we were able to attract a really incredible, sophisticated set of creative thinkers who identified the alpha opportunity and helped us launch Fund One. Now everybody sees what we saw. Now everybody likes to talk about this. The magic is being willing to see the non-obvious and act. That's the hard thing. And our team is really good at that across both strategies. We're very comfortable being out on that edge of innovation where the fog is thick, the path is unclear. It's lonely there, but where it's lonely is typically where alpha is harvested, right? So we talk a lot about that as an organization. Another way to articulate that is your right to win. We have a right to win in North American sports because we are the only institutional investor approved by each of the leagues. We have a massive data business and information advantage. We have an incredible value creation program tailored specifically to the North American market. If we step out of North America, we better have a damn good reason to do it. And we tell our investors, hold us accountable. This is what we told you we were going to do for you. We told you 80% plus would be North American. If we go outside, it's going to be an unusual opportunity. It's either going to be helping a North American owner expand their holdings globally, or it's because we have an opportunity to do something really special, really unique with a global asset that might want our help in North America. So they can leverage our right to win. Okay? So that is the framework. When we take a step out international, that is the lens at which we apply to the opportunity. We have some incredible partners in European football and in motorsport. We're partnered with Steve Paliuca and the Bain Capital team in our investment in Atalanta, who just won Europe. A lot of people don't know this, but Atalanta has one of the best player development camps and programs in the world. It has a player cost advantage. And it has generated more free cash flow than any European football club since 2019. Paris Saint-Germain is a global consumer brand. It's becoming a luxury brand. A lot of Americans don't know Paris is the biggest metro market in Europe. And PSG is the only club in Paris. And the catchment that PSG has for youth talent, the academy that they just built, they have engineered their way into the same talent advantage as Atalanta. And they want our help building their commercial operations in North America. How do we monetize and build the PSG brand in North America?
So I have to ask you, because it was going to be next on my list about PSG, Paris Saint-Germain. I think you bought your stake off the Qataris, who would have been more than aware of the attractions of the asset. What motivates, in that case, the seller?
If I can touch on Aston Martin, and then I'll come back to both of them, because I think the rationale for why they were looking for a partner and why they chose us, it becomes self-evident. We have studied Formula One since the firm's inception, really. And one of the things in really illiquid markets, so I'm not talking about sports right now, price data and the frequency of that data are really valuable things. Okay. If you and I live on the same street and a house hasn't sold for 5 years, we might have a guess what our homes are worth. But if our neighborhood's fairly homogeneous and homes are selling all the time, you and I know exactly what our houses are worth, plus or minus 5%, right? In sport, there isn't a lot of clean transaction data. The frequency of transactions is low. The data is hard to get. And the assets are not homogeneous. And so sometimes you go through phases where price discovery hasn't happened in a while. But the underlying fundamentals that drive price have gone through significant change. If you and I bought our houses at the same time, when interest rates were really high, and housing stock was abundant, but nothing had sold for 15 years. But over those 15 years, interest rates had gone from 8 on a mortgage to 2. And the market that we lived in had so much inflow of new people that the demand function had dramatically changed. But there was no price discovery. Our homes might be worth 5x, 10x, but we don't know. That phenomenon that I just described happens in sports from time to time because of the lack of frequency and the lack of clean data and the big changes in fundamentals. Okay? Now I'm going to talk about Formula One. Formula One as a business has been transformed over the last 15 years. And I do want to give a shout out to my friend Nick at CVC. CVC did a phenomenal job with Formula One. Then they sold the league to Liberty. And Liberty has done an amazing job with that global intellectual property business that is the league. Formula One has 10 owners, 10 teams. They all have 2 teams that they run, but there's basically 10, where in North America there's 30 or 32. The big difference between the Formula One league sharing and the North American leagues is performance matters. You get paid a little bit more depending on where you finish. In North America, and I should have said this earlier, it's very strange that the United States or the North American sports leagues have a socialistic construct. You get the same check from the league if you're in a big city or a small city. Last place, first place. And weirdly, if you're the worst team, you get the right to pick the best amateur player in your sport. So this like competitive integrity and competitive balance feedback loop in North American sports it's a really unique thing. In Formula One, the dividend from the league gets divided by 10 with performance adjustments. But there hadn't been price discovery in Formula One for a long time. And so a lot of the changes that CVC made to the league business, a lot of the changes that Liberty had made to the league business, the growth of the sport, especially in the United States, the brand awareness, the value of the intellectual property, and the future cash flow of these 10 slots had gone up materially with no price discovery. Okay, that was our thesis in Formula One. Several of those clubs will never sell. Right? They just won't. Many of those franchises are not competitive. So they're kind of down in this lower revenue scrape. And if you want your brand to be associated with winning and luxury, you don't want to spend money on someone who's just down here. So our view was in that sweet spot in the middle, can we back an incredible entrepreneur who's made significant money serving kind of the luxury consumer, who has a big, ambitious vision and has some structural competitive advantages that are about to unlock over the coming years? We found all of those things in Aston Martin with Stroll and his commercial team. And so we believe we've come into Aston Martin at a very attractive discount to intrinsic value, at an inflection point in that asset, with an owner-operator who is a proven entrepreneur, who has a big vision for that business. And we know we can help them monetize that brand in the United States, and we've already started to help them. That's a perfect partner for Arctos when we step out internationally.
let me understand, is the investment you've made in the Aston Martin F1 as distinct from Aston Martin, the limited company, the manufacturer that is forever having problems?
Our investors have exposure to the racing franchise and its related assets.
Got it.
And we think we've got a phenomenal partnership there.
So that's clear. And so let's move back to football, because your stakes are, I think, via a Fenway group, you're in Liverpool FC, and I think Fenway seem to pay a very modest price. And then there's this quite large ticket to those of us who know very little about, with regard to Paris Saint-Germain. And then most of us, and I happen to live in Chelsea, have been scratching our heads ever since, the acquisition of Chelsea, which you may want to, although it's nothing to do with your business, you may want to comment on because there are many of us who are perplexed. Tell us first of all about the Paris Saint-Germain.
So if you think about Aston Martin and PSG, what were they looking for? Neither of those ownership groups needs capital. Both of those groups want access to best ideas, deal flow, and monetization strategies for their brands. And they are dominant in their local markets. And so we can help Paris Saint-Germain think through the strategy for its arena, how to optimize the fan experience in the existing structure versus the opportunities to build something brand new for that fan base. We can also help them think about monetizing and building their brand in North America in a way that enhances the flywheel they already have to put a competitive product on the pitch. But again, our core focus is serving teams and leagues and delivering on our mandate to our investors. So international sport is only about 10 to 15% of what we do today.
So help me in understanding the risk. The closed league syndrome that exists in the US is a moat, to use Warren Buffett's terminology.
Correct.
But the problem about the European operating sphere is that you can pay a championship league price and then find the club's been relegated. Okay. And you end up with something that says, just how do you think about that risk?
I think a lot about it, because even if your probability of relegation is only 5%, a geometrically linked 30-node, 95% probability over 3 decades is damn near a coin flip. And what's strange is, or it's not strange, it's just math. If you apply that probability to the valuation multiples in North America, it's kind of similar to the valuation multiples that are paid in Europe. The lack of relegation risk is one of the reasons North American franchises should trade at a premium multiple. And so if you think about where we've gone and when we invest, there's no relegation in Formula One. Atalanta has a dramatic cost advantage that is also an insurance policy against relegation through the academy, right? Paris Saint-Germain has the lowest probability of relegation of the big European franchises because of its position in Paris, because of its dominance in that market, and because its global brand creates this flywheel that protects it from relegation. Liverpool has the same thing. We have an extra layer of protection in Liverpool because we own Liverpool through a portfolio of holdings called Fenway Sports Group. And then on top of all of that relegation probability and analysis, we're pretty good at structuring these deals, right? Our investment acumen is in around pricing risk, structuring risk, and so we layer in our own structural protections at the deal level. But I love that you referenced Buffett's moat. We talk a lot about the moat. The moat for us is the regulatory moat that the leagues have constructed for institutional capital. It's really hard to get over that moat. Okay? But we also talk about the wall. We've made it over that moat in every league. And as soon as we made it over, we burned the bridge, and we, like masonry workers, just started building this wall of data, value creation services, analytics, because if anybody else makes it over that moat, we want them to hit that and wobble a little bit, because we want to protect our alpha harvest for our investors. So we're very intentional about our right to win and where it exists and where it doesn't.
Now, before we leave football, I picked up the paper last week and there was this heading in the Telegraph. It says, "Fans wage war on clubs pricing out children and pensioners." And a banner at Tottenham Hotspur said, "This is no club for old fans." Now, you've made the case for the non-cyclicality of some of these businesses. A recession comes along, interest rates are up, consumers want to spend less on tickets, they want to spend less on ice creams and beers. How do you think about the elasticity of demand of the consumer who is your fan?
That's an awesome question. I don't know that anybody's asked me that question in that specific way. So thank you for that. That was very cool. One of the things that I noticed in the data when we were getting ready to start this thing was how incredibly durable even the most volatile part of the revenue streams in this space are. So in 2008 and 2009, each of the North American leagues grew ticketing revenue, which is kind of crazy. But this is a weird industry. Your customer is called a fanatic. And after rent, your car payments, food and beer if you drink it, for the customer of this product, it is the most important. You don't cut it. And for many ticket packages, there's the equivalent of a down payment. You buy a seat license, which gives you the right to buy the ticket. And if you don't buy the ticket, you lose the right. And you got to get back in line. And so the consumer elasticity is very unique in this space. Okay. But I want to go back to kids. The single best predictor of a fan for life. It's like a 95% conversion. If you can get a kid into the venue before they turn 14, 95% conversion, they identify as a fan of that sport for their life. I'm very excited about that statistic.
Wow.
Because one of the things that's coming that people don't even see, it's not in the expectations for this business. It's not in the valuations of these businesses. Very soon, you're going to be able to give billions of kids that experience in their home. We have seen demonstrations of augmented reality technology where you don't have to have like the thing strapped to your face, but where you could put a kid in the game, in their school uniform, with their friends or their siblings. And if the conversion rate for a fan for life is get a kid in the venue before they're age 14, and it's in the 90s as a percent conversion rate, what is the conversion rate if you can sit down on the couch to watch your favorite team play football, but your two kids, for a $5 upcharge, can be grafted on to two great players from that team, and your kids can watch themselves playing for your club, cheering for your team, and you guys all celebrate because one of your kids made the save or scored the goal that won the game. The reach and connectivity that these clubs are going to have with kids soon, and create this really unique experience for them and their friends and them and their families, is pretty cool. So I don't worry about fan engagement. Like if you look at all of the data for youth sports participation, it's very healthy.
Sorry about that, Ian. Okay. My Labrador seems to have gone mad. Okay, back to you. Sorry, say again.
What's that dog's name?
The dog, Chulu. It's an African name.
Chulu. Chulu. I like
Chulu,
that.
yeah. Oh my God.
What does Chulu mean?
So it's a set of hills in Kenya, and we were there with the family, and the children had gone on a few years ago by getting a dog, and then they were there with these Chulu hills, and it was like, okay, finally we relented because my son, so Chulu, Chyulu, strange name, and you spend your life explaining it.
No, I love it. All of my wife and I are both from Alaska, and all of our animals have an Alaska name, and they're weird names, but like no one knows like what the hell are these names? They're just meaningful Alaskan places and geographic things. It's Chulu. I love that.
Thank you. Anyway, I interrupted you. You were interrupted by the dogs barking as you were explaining.
If you look at the data for youth sport participation, it's all very healthy. The key to fandom for life is feeling connection to a club, typically by going to an event. And I think what's really exciting is the ability to create something like that opportunity for hundreds of millions of kids that will never have that opportunity is going to be possible very soon. And that's pretty exciting. I
understand. So technology is clearly going to be a game changer, excuse the pun, and the youth statistic that you gave, I had no idea about, and I absolutely see that. As somebody also I read said that, the Apple iPhone will long be extinct, but people will still be going to watch their baseball team or their football. So I get the duration. Yeah, no, it's one of the things I talk about with our investors is, if you invest in toll roads or airports, those are really important fixtures of their community. But we have airports in my town and we have toll roads in my town. I don't know if those are going to be the important pieces of our community's infrastructure in 30 years. The New York Yankees Major League Baseball team has provided its owners with a compounded return of 9.8% annual for 119 years. The obsolescence risk of these brands is very low, and that is hard to find. Although the interesting thing about Paris Saint-Germain, which I didn't realize, is its uniqueness in Paris. But London, for example, has a ton of very good clubs, and there's a very full price being paid for Chelsea. How did you reflect on that as somebody who is all the data and knows this space? I want to pause for a second. I don't want to say too much about this because my friends are owners of Chelsea. I don't have a lot of transparency into their plan, but I know that they've built phenomenal things and are great investors. And if anybody can do it, it's them. Just going back to this idea of these long duration assets, two things strike me. One is that in the private equity business, you raise these funds that have a fixed timeline, and yet you're really making the case that these are permanent capital, enterprises you'd like to be with forever. I mean, are they sitting in the right vehicles in private equity? You did your homework. These are great questions. These investments do not naturally fit into the traditional 10-year private equity fund structure. And in fact, several of the league's rules and restrictions make it very hard for that traditional fund structure to be used to own their clubs. I'm not good at dynamic ticket pricing. The colleagues that have backgrounds like mine, we don't really know how to sell sponsorship. We're not media rights experts. We work with people that are phenomenal at all of those things. But some of us are really talented at structure and illiquidity and solving those things. So it may not surprise you that we don't have a traditional fund structure. Our structure is tailor-made to address the needs and goals of the leagues and the owners of sports assets, but also the needs and requirements of the institutional investor community. We serve both, and it's probably no shock to you that our structure is a little bit different, tailored to this particular industry and its needs. Understood. So, how should institutional investors listening to this and weighing up whether allocations in the future may make sense, how should they think about exits? And how should they think about returns?
We have this really unique opportunity and responsibility to represent private markets to sports, but also to represent sports to institutional investors. And that is a it's a big opportunity, but it's an important, there's a stewardship element to that, right? And to support any new sector or asset classes growth and evolution, you need data. One of the things that we did this year was partner with the University of Michigan's Ross School of Business to create a North American sports index where every quarter we clean, scrub, and add new transaction data to that index so that the investor community has a clean benchmark, the academic community has a clean benchmark to test and study and evaluate this opportunity set. If you had had an opportunity to invest in North American sport during the most accommodating decade of my career for private markets, call it 2011 to 2021, when just the levered carry trade on any equity worked, right? Pooled average private equity returns over that decade, about 18%. Real assets gave you kind of 9 to 11. The S&P 500 gave you 10. North American sport with no discount, no selection skill, just beta factor, gave you 16. Again, with no leverage, no correlation. Okay? In a very different environment, mid-1960s to mid-80s, there was no leverage buyout venture capital market back then. During those 2 decades, the S&P 500 did not outperform inflation. It did allow you to preserve your wealth, but it didn't create any real wealth, being long equities for 20 years. Inflation was volatile. The 60-40 portfolio didn't work. During those 20 years, North American sport, again, with no skill, no discount, no structural advantages, gave you 15 to 16. Okay. So when I talk about this sector to investors, I think a big mistake that private markets practitioners make is trying to predict beta factors, because people aren't good at that. I don't know what the S&P 500 is going to do over the next 5 to 7 years. I have a feeling. I don't know what pooled average private equity is going to do over the next 5 to 7 years. I have a feeling, and I can think about it probabilistically. I don't know what being long professional sports is going to do over the next 10 years. But I do know that as a firm, we have a unique ability to deliver alpha on top of that beta. And so what we pitch is institutional scaled access to this unique beta factor that all by itself has been a risk reducer and a return enhancer. And we do it in a way that no one else has been able to figure out yet. There are no firms that do what we do. There are lots of people that say they're sports people, but they're doing the sports ecosystem stuff. We can give you access to this very hard to replicate beta factor with alpha. And I'm not going to tell you what the beta is going to do. I can tell you what it's done, and I can tell you why we think it's going to be attractive. And if we don't deserve to be stewards of your capital, because the only reason to be illiquid in private markets is if you're getting alpha. And so we think in an alpha framework in everything that we do, whether it's in our Keystone strategy or our sports strategy.
So I was going to ask, although I think you've partially answered it, about the amount of capital that is now searching out those opportunities that previously might not have done, because typically excess capital, competes, drives down returns, and your return is a function of the starting point, and valuations have increased. Is this shorthand for saying, actually, you built some, if not moats, you built some walls that give you a head start?
Yes. The key question is, what is the intrinsic value of any asset? are you able to acquire a position in that asset at a discount to intrinsic value? And can you add non-market performance to that asset during your hold period? That is how private markets investors are supposed to generate alpha. Most return from private markets has come from beta hitchhiking, strong markets, multiple expansion, neither of which the manager has anything to do with. And there's all kinds of work that Bain and others have done to disaggregate that. For our firm, we're laser focused on making sure that we invest in people, services, data, and software that continue to reinforce. They don't have many choices because that regulatory moat is so wide and so deep. And that price discovery process we talked about earlier. NBA valuations have been going up because everyone knows that everyone knows the NBA was about to reprice its national media contract, and there was tremendous upside in that contract. So about 18 months ago, you started to see transactions being priced off of forward multiples. If you have access to the data and the valuation framework, you can distill how much of the pricing action is tied to fundamentals versus supply-demand dynamic for the asset. And we don't see any material mathematical change in the supply-demand of capital. I told you I'm a nerd.
That's very clear. And I didn't call you a nerd. You called yourself.
Yeah, you said I said I'm a nerd. That's a very polite way of calling me a nerd. So you are correct.
I sometimes wish I was more of a nerd. Now, I have got a few closing questions for you, and one comes from the great Michael Lewis, author of Moneyball, along with all those other great books. He's been a guest on the show twice, so I couldn't resist. Cool. I couldn't resist sending him a line. And if you haven't, he's come on twice, and he and I actually met originally at the LSE. And he said, and you partly answered this, but he said, do you think there's still inefficiencies to exploit? And if so, which sports?
First of all, super cool that question's coming from Michael Lewis. That's awesome. Moneyball is an incredible story around the creation of what has become a big part of sports analytics. And in baseball, it's wins against replacement is like the key metric. You and I might describe wins against replacement as alpha. Am I getting extra juice over the average manager in this sector? That's really what WAR is alpha. Our team was involved in helping write some of the early versions of alpha diagnostic software in private markets. Through our Keystone strategy, we provide other managers with some of the most sophisticated alpha diagnostic software in the world. Okay. We've taken everything that we've learned from disaggregating skill and luck in private markets, and this won't surprise you, but we have built an alpha engine in the business of sports. And what's really neat about the business of sports is there's actually two different decision-making groups in each of these enterprises. There is the group that is responsible for fielding the team, constructing the roster. They are constrained by the salary cap of the league, if there is one, and the controlling owner's propensity to spend if it's below the salary cap. So they're given a certain quantum of capital, value at risk, right? And their job, mathematically, in our framework, is to manufacture hope. So we actually have really cool tools to understand which clubs have skill or alpha at producing quantums of hope per euro or dollar spent. That is a frontier no one is looking at. But then there's also another group inside of the franchise. It's the business ops. And their job for their market, for their brand, is to take the units of hope and monetize them. And that's a totally different skill. Okay. So one of our operating partners, Theo Epstein, is in that Moneyball story. And he's one of the best in the history of Major League Baseball at manufacturing hope per dollar of spend. Okay. But also in our portfolio are biz ops people who are literally in the Hall of Fame of their sport for their business execution, because they were able to take hope and turn it into an abnormal amount of value. And so there are many ways to identify inefficiencies. I'm not sure if that answers Mr. Lewis's question, because I think he's probably asking about player selection, but I'm not allowed to be involved in that, right?
Well, we're happy to have a dinner with him in the autumn in London, and we'll be definitely quizzing him, more. Now, 3 closing questions. One actually isn't a question. So my business partner, Will Campion, whose idea it was to found this podcast, is a long-suffering Everton fan. And he said, "When are you guys going to take me out of my misery?" So you don't need to answer that. He should have just supported Liverpool all his life. The second question is, there's been this discussion, and there was an immediate furore, but sometimes these things are the first spark of a closed Euro Super League. Do you have any thoughts on that?
So I think what I would say on the Super League concept is the goal or the objective of that vision. I'm not going to comment on whether it was the right thing or the wrong thing, but I can help shed light on why that was an interesting idea to the people that proposed it. A Super League structure looks a lot like the structure of a North American league. And there is real value in the structure and the scarcity of the North American League content and product. And so I understand the math behind the idea, but I also understand the emotional response to the idea, right? And it's really important to balance both of those, right? There's a similar risk bubbling in the United States around collegiate athletics. Should collegiate athletics have private equity money coming in? Is that a good idea? Right. Those are communal tribes, right? It's America's version of the European football fan, right? It's the collegiate athletic fan, and so this is a very unique industry where you have to balance all of the stakeholders and think in really long horizons. And I feel honored to be a very small participant in it.
So, Ian, in closing, people in the investment business tend to skip over their setbacks and failures, and they also tend not to talk about the lucky breaks they've had. Can you comment on A, lucky break, and B, when you've had a setback, how you dealt with it and what you learned?
My lucky break was 27 years ago when my wife said she'd go on a date with me. And she only said it because my best friend, he's still one of my best friends, convinced her she should give me a chance. So that's my lucky break, because she has
Good one.
Believed in me when I didn't even believe in myself, and supported me throughout my career. When we started Cogent, and you have to, every entrepreneur, there's this moment where you have to step off the edge. You know this, like starting this podcast, like any entrepreneurial endeavor, you have to step off the ledge. And having the courage to do it is half the battle. It's like we have a mantra here. Anybody, entrepreneurial pursuit, you have to help them. Unless they're an asshole, you got to help them. Because so many people have helped us that we don't even know to thank, right? I was only able to step off that edge to start Cogent because my wife was a special ed teacher and her check paid our rent and it covered our car payments. And we could afford for me to take the risk, right? So she's my lucky break. Failures, we don't got time for that. To humanity.
Any one lesson that you would share with an audience of ours?
My favorite one, and he probably, I know he doesn't remember this. One of the first managers I ever met at that fund of funds. And you got to remember, the rage was venture capital. The rage was tech, right? I met this guy who came in talking about debt and how you could actually buy companies cheap through their debt. But they weren't tech businesses. They were like industrial businesses. And I remember sitting there listening to this guy pitch, thinking, man, this poor guy, he doesn't get it. He's missing it. 9 months later, I'm staring at a pile of presentations. Every one of them needs to be thrown in the dumpster because they were trash and the market's on fire. But there was this one deck from this guy, and damn it, was he right. And everything he said was like so obvious 9 months later. And it was Howard Marks. Yeah. And I wish earlier I had, with intent, spent more time with really skilled investors, or at least just consumed more of what they had put out into the ether than I did. Because there's so much value in the lessons that have been passed down from these iconic investors. And I had to learn my own lessons, by getting kicked in the teeth and punched in the face. And I probably could have avoided a few of them if I'd spent a little bit more time studying the lessons that have been passed down to us by the forerunners of this industry. But that's my favorite story.
Yeah, well, me too, echo that. And it was interesting. We had Mike Milken on back earlier in the year, and there was the guy who understood. There was the guy who understood how debt takes control of the company,
one of the most brilliant people I've ever interacted with. It's incredible.
Yeah, and he was a terrific guest, so felt very privileged. I am going to let you go, but actually, for people watching on YouTube around the world, one curious thing is you and I have pictures behind us which could not be more different. I have to ask you, what is the creation, because that's the word I'm going to use, that sits behind you?
So the artist of this piece is an incredible young man named Timmy Sneaks, based up in Boston. And for the people that are watching, the photo in the center is an iconic image from the movie Die Hard with Bruce Willis. Where he's crawling through this air conditioning duct, and I had this piece made really as a support for myself. I was really frustrated about some professional things that were going on in my life, and this was like a creative outlet with Timmy, and it was a lot of fun. But its origin story is from a place of frustration. Okay, the reason I hang it in my office today is that I had this piece made 8 or 9 years ago. And I met my partner, my co-founding managing partner, David O'Connor. He's this beloved icon in sports and live entertainment. He started at CAA, became the managing partner of CAA, helped build CAA Sports. Then he went on to be the CEO of Madison Square Garden, this huge publicly traded sports and live entertainment conglomerate. And he's become one of my dearest friends. He's the first mentor I've ever had. He's just this incredible, beautiful soul. And I'm so grateful for my partnership with him. But guess who negotiated Bruce's contract to do the movie Die Hard? My partner, Doc. And so this piece is, to me, it's a bridge from a part of my career that I was frustrated about to a part of my career that I'm very grateful for. And it pops on Zoom and YouTube and things like that. So Timmy Sneaks, Boston, great dude, does amazing stuff. That's where it comes from.
Fantastic. Well, if anybody's looking and they're going, okay, now what's sitting behind Simon Brewer today?
Yeah.
If you are a James Bond aficionado, you would know that this is on Imagine the Secret Service. This is one of the Italian cinema posters from 1969.
Super cool.
George Lazenby only appeared once in a James Bond film and apparently wanted too much money and made himself unpopular and never got a second role. Roger Moore stepped in. I was with my wife yesterday over in Murin and we scaled the Shilton. You can do it. It's 4,000 feet. It's a steep, but it's not a technical climb. And the revolving restaurant is still there.
Oh, wow.
All those years on, and they have a James Bond museum. So the Shilton, it's called Pizza Gloria, and I had to come back. We came back last night, and then we watched the film with Telly Savalas and Diana Rigg. And so it just still is a great Bond film. So I'm a very sad Bond man who, if I had another life and anybody wanted, I know what I'd like to have been.
I love it. I love it. Simon, thank you so much for this. This was a lot of fun.
All content on the Money Maze podcast is for your general information and use only, and is not intended to address your particular requirements. In particular, the content does not constitute any form of advice, recommendation, representation, endorsement, or arrangement, and is not intended to be relied upon by users in making any specific investment or other decisions. Guests and presenters may have positions in any of the investments discussed.